Today, we are going to analyze a company where the share price has been decreasing for the past year. And this company is going to be Starbucks, ticker symbol SBUCKS. And if you would like to start investing, feel free to check out the link in the description. And you can read about eToro, and feel free to register a practice account with eToro so you can start by learning, investing, reading news. And the reason why I have decided to make this video is Starbucks is a very exciting company. Most of the American people probably know about it. Of course, Europeans also. It has been a fast, increasingly growing company, but their current earnings has been decreasing. So that's what we basically see in the pricings. And we are going to try to answer the question, is it the right time to buy the company? Is it the right time to invest into Starbucks? And let's get into it. So first, we are going to open up the income statement of the company, where we can see that their revenue has been increasingly growing in the past 10 years. And since we are value investors, we are going to look at it on the long run. We don't really care about these Qs. We look at the total picture and we have to figure it out if it fits into our expectations in regards of our returns. So we can see basically that their revenue has been slightly decreasing, especially, like the growth of the revenue increasing has been decreasing. So basically, their growth has been decreasing, although their revenue have increased. And if we look at their gross profits, it's also the same picture. And on average, they make about 29% gross profit, which is extremely good if we look at a company like this. And if we look at their profitability, it is extremely a profitable company. You can see it in row 26. So this means that this company is making a very nice profit. The profit has been slowing down slightly. So this is why investors have been thinking, maybe it's less worth in terms of the price of the stock. And this will leave us with a 22 price to earnings ratio, quite high, and also a 22.91 price to free cash flow ratio, which is also very high. In regards of the current ratio, it's below 1. So it's something that I really don't want to see in a company if the current ratio is below 1. So what is the current ratio? The current ratio is the current assets / the current liabilities. And if we go quickly into the balance sheet, I'm not going to read the whole balance sheet, but if we want to see something that a little bit worries me, and you have to get into why the company is going to this way. If you look at the long-term debt of the company, you can see a nice increasing tendency, which I don't really prefer. And on the other hand, you can see that their assets, the total assets, are shorter than the total liabilities. But if we want to take a deeper dive, you can see that their property, plant, and equipment net value is still higher than their total long-term debt. So it's not. I'm not calling that it's not safe. It's just something which, from accounting perspective or from a safer investor perspective, it's better if you have a company that has more assets than liabilities. If we look at their cash flow, which I really like to see in a company, especially we are going to do a discounted cash flow analysis, we can see that their net operating cash flow, so cash from operations, has been increasing since 2020. Let's look at the 5-year timeline. So there has been a sort of drop in 2022. You can't really, from 2020 till 2022, you had this coronavirus stuff, where 2021 was an extraordinary year for everyone, for all of the earnings. And then 2022 was a slight decrease in everything. And then let's say the first normal year was 2023 and then 2024. So we can see that their growth is sort of back on track. It's a slower growth than it was expected by investors and the company. But if we see their free cash flow, we can easily forecast maybe for the next 10 years. So we are actually going to do that. Just before that, the company is paying out dividends. It is paying out 2.8%. So the yield is 2.8%, which is okay. And the payout ratio is 60%. That's also considerably healthy. So if we are doing a discounted cash flow to equity model, it's a simplified version. You can basically see that their cash flow has been not stably growing. So it's hard to forecast. So I was staying on a 12% growth for the next 10 years. So basically we are forecasting the free cash flow or the future free cash flow growth. And we are going to take it back to present value with the discount rate, which is about 11%. And that will leave us with $55 or $56 dollars per share. And that is below the current stock price level. This gives me a reason actually not to invest in the company, although I think it's a very nice company from looking at the business perspective. For example, Starbucks does not do any franchising. They are expanding on their own power. That means they have a wider control on the stores, and it's much easier to manage everything from a center basically. And also they are owning or renting or long-term renting, leasing assets which are money generating. For example, owning a Starbucks in the crucial places where people are traveling, and also in Disneyland, so entertainment places. So that is the real non-tangible asset for Starbucks. It's basically a community place for the people to go to study, to drink a coffee, to eat a nice whatever. So basically, if we would like to compare it to the S&P 500 total return versus total return, we would get a picture that if we would look at the 10-year horizon, Starbucks would have not done that bad against the S&P 500 if this turn back didn't happen 2 months ago. So maybe the market is overreacting the current situation in regards of Starbucks and the Chinese slowing growth. Because if you would just look at the 10-year average, Starbucks has always had a higher growth than the S&P 500. So basically you see a turning point at that segment 2 or 3 months ago. So this can be a current issue. Although I am not very interested in the company, it will stay on my watch list, and we will see how it will turn out in the next few months, years, and hopefully 5 to 10 years. Make sure that you subscribe to the channel, comment the next stock that I should analyze, and don't forget to check eToro's registration link in the comment section. Have a wonderful day to you. Goodbye.